Everyone, welcome back to the Market Chat. My name is Richard Moglen. Joining me here today is Duckman1717, renowned CANSLIM trader over on FinTwit. And although he remains incognito, he has agreed nevertheless to share with us his process and methods with us here today. Duckman, thanks so much for being here. Welcome to the show.
Thanks, Richard. Thanks for having me.
Yeah, my pleasure. So why don't we get started with kind of your background? So if you could kind of tell us a little bit about where you learned how to trade and kind of your journey along the way.
Yeah, sure. So I started in 2004, and it just so happened it was a class project that I was assigned as a senior in college, and maybe I was a junior, something like that. But anyway, it was a securities analysis class, and my professor was a CFP working on his CFA, and he had a project for us with regards to how the quickest returning stock in a semester that has certain value metrics attached to it. So it's got to fit this value mold, sort of a Benjamin Graham, Warren Buffett style mold. And if it's outside those parameters, it's not a stock that can be used in the competition. So the irony of it is the best growing stock that doesn't really have any CANSLIM or growth characteristics. So long story short, the guy who won it, I came in last place. I selected a stock called Temple Inland. I came in dead last out of, I think it was a group of probably 40 students. And the guy that came in first bought TASR. And it's probably one of the most well-known growth stories that we all love to talk about and look at. And it's what an amazing chart of TASR, and what an amazing product that it did. But you know, the guy that picked it got in, he actually didn't, he got a C on that particular project. And the professor kind of, not necessarily scalded him in front of everybody, but it was really more of, you know, that you didn't follow the instructions. You should have picked something that had a really good PEG, price to earnings growth ratio. You should have picked something that had a better tangible book value, or whatever, price to tangible book, whatever the metrics are. And so despite him coming in first place, he didn't get a good grade. So after the class, I pull him aside and I said, man, that stock returned over 100% in such a short period of time. Why did you choose that one? And what led you to that stock? And he said, man, my dad is really the kind of the guy that told me about it. But he said, my dad is really big into Investors Business Daily, and has read the book, How to Make Money in Stocks. And it's like, I just kind of went off my dad's choice on that. And so I found that so interesting. So after literally probably, I guess after class, I went straight to, I think it was Barnes and Noble at the time, and grabbed the book for $29.95, man. And that's my story. And then ever since then, it's just been, that's been what I love, and that's been sort of my mold. So
absolutely. And other than How to Make Money in Stocks, which is a great book, has there been any other kind of titles that you think has really helped you expand your knowledge when it comes to CANSLIM type trading?
Yeah. So, and by the way, I love your interviews, and so many people have had such great feedback to the interviews. I've learned a lot from your interviews, by the way. And
thank you.
I just want to say thank you for having me on again. But it's interesting that a lot of the interviewers sort of have the same books that they recommend, or that they liked, or that they love. And Reminiscence of a Stock Operator, I've heard that one a million times. And I agree. I think that that's a fantastic stock, probably, or fantastic book, and probably one of the best books ever written out there. Supposedly a guy that who isn't Jesse Livermore, who probably was Jesse Livermore that wrote that. We don't know 100% sure. We're not 100% sure on that, but it just sounds like Edwin Lefevre had a very, very intimate knowledge of Jesse Livermore and the stories et al. So anyway, but that's a really good one. I love that one because it, you know, the talks about the bucket shops, and, you know, just him seeing the patterns of the numbers of these bucket shops, and being able to read on a chalkboard as the tape is being printed out, being able to read these numbers and see a little well-defined pattern within those numbers. And that he was identifying, just simple support and resistance levels. And he knew that when wheat broke out above $20 or whatever, it kept bumping up against that $20 mark, and then boom, hits 22, 23. And that's when he's buying, and he was buying a base breakout. Pretty phenomenal stuff. I would say Nicolas Darvas, How I Made $2 Million in the Stock Market. Another phenomenal book. And one of the key takeaways for me on that one was his delayed quotes. I think that the information nowadays is just so readily available to everybody. Yeah. And I don't think people understand the value of stepping away from the market intraday and getting away from the constant quotes that are coming at you intraday. It's remarkable that this man was able to make as much money as he did. I think it's equivalent that in that given time frame. I think I did the numbers, and I want to say it was roughly 35 million in today's money, and that was a very small time frame. I want to say it was less than 24 months he was able to do that. And he was able to do that, literally across the Atlantic Ocean, dancing in Europe and getting his quotes sometimes a week after the actual quote printed. So I think it's pretty remarkable that man was able to do what he did, and it just goes to show that it further emphasizes, why weekly charts are so important. Those weekly closes are so important. And anyway, so that's a really good one. As far as a book, though, that hasn't really been talked about too much, I would say I really like the Encyclopedia of Chart Patterns. I think the Encyclopedia of Chart Patterns is a phenomenal book. Chart patterns are, they're just sort of a representation, in my opinion, of psychology and of human emotion. It's good to know the patterns, but then it's good to know what's going on within the pattern. We'll get into some of that stuff, I guess, later on in the interview, but you really want to know the patterns first. And then when you understand the patterns and what they're telling you, you just get an edge on the market itself, or at least on relative to what you're trying to accomplish, whether you're shorting or going long. But I really like that book a lot. The Bulkowski guy, he's a pretty great guy. He did a lot of studies, actually. If you look into that book, he actually did a lot of studies on each individual pattern. He actually gives some props to Bill O'Neill in that particular book too, with respect to the cup and handle, which we all know what that is, and we all love that pattern. And he provides some good data on it. So yeah.
Very cool. And day-to-day, kind of what software and tools you use for both kind of doing fundamental as well as technical analysis, all the way up to actually looking at the price action and buying the stock. So what software do you use day-to-day?
So I use TC2000. I'm a fellow TC2000 compadre with you. I know you like TC2000. I love the work that you've done with it. And, I think, that program is pretty remarkable. I'm not an IT guy. I'm not really good at the computer stuff, but I will say this. I think that I wanted to kind of, when TC2000 first came out, I think it was, stockcharts.com, or is that what it was called?
Telecharts, I think, right?
Telecharts. Okay.
Yeah.
When it first came out, it kind of had this almost like Microsoft Excel base to it. It kind of felt like even if you look at it now, it kind of still has that feel to it. I don't know if it's running in the background or whatnot, but it really kind of jived with how I like to look at things. I'm an Excel guy, so yeah, it fit my personality a lot better than, say, something like a eSignal or a TrendSpider. I think eSignal and TrendSpider, those charts are fantastic. They look good. Very good. Stockcharts.com, another one. They look really good. But something about TC2000 just kind of fit with my own personality. And then as for the technical side, on the fundamental side, MarketSmith all the way. I think MarketSmith is an unbelievable tool. It gives you a complete edge up on the market. And I'm not just saying that. I don't, I pay just like everybody else, subscription wise. I pay whatever it is every year. And I don't get I don't get kickbacks from MarketSmith. But I think it seriously is probably the best tool out there. And you can certainly do a significant amount of technical analysis on MarketSmith. And the one function of MarketSmith that I love the most is the ability to go back in history.
Yeah.
You can do that on TC2000. I think it's a little easier on MarketSmith, where you can just plug in a date and then you just kind of go and instead of having to scroll at the bottom. But needless to say, both are very, very integral in my process. Yeah.
Yeah, and I think we're going to do a little bit of that, going back in time and looking at the previous bull market, the huge run we had from the start of the bull market in 2009. So I'm looking forward to that. And MarketSmith, getting into your kind of trading strategy overall, how would you classify your trading from the spectrum of day trader all the way up to an investor? Where do you kind of put yourself?
Yeah, so I've kind of morphed and evolved over the years. When I first started, I was very, very short term in nature, and I'm talking when I first started. I couldn't sit. That was one of my biggest problems. It still is probably one of my biggest problems, is being able to sit. It's incredibly difficult. But needless to say, I would say probably closer to a swing trader, like almost 100% when I first started. And then started noticing, what started to bug me over the years is watching, I'm getting my 20 to 30% gains. And then what started to bug me was watching just so many stocks rip higher, another 100, 200, 300%. And I'm just like, why am I not catching these moves? I want to be in those moves. And it started to upset me so much that I was like, okay, I'm done with this. Like, maybe this is not my personality. Maybe swing trading is just not really my thing. I knew I wasn't a day trader. I knew I could never do that. But have I ever done it before? Absolutely. Yes, I've day traded, but it very small. And sometimes I just do it to piss off Laguna Padre, my best friend at Eddie V, because he just him and I are going to have an inside joke about day trading. But needless to say, I think I am what the market wants me to be. And there are going to be times, and there's going to be markets where, maybe it's not conducive to be a position trader. Maybe there's going to be times where the market's really telling you, hey, you probably need to swing some stuff, like kind of like you and I talked about yesterday.
Mm-hmm.
There's going to be markets where it literally just chops sideways for years. And what do? Do you play it, or do you just sit on the sidelines and wait for your pitch? You can do both. You can certainly just be in cash, or you can buy the dips and sell the rips and just, do your swing thing and hit your, 10, 15, 20, 25%. There's nothing wrong with that. And we're going to get into a little bit about the Fed and my conviction, and as far as why I think this bull market is still young. But there are going to be times where, in my opinion, I think that you need to be a position trader. And that's, if you can stomach it, because there's going to be a lot of moves out there. We saw that with 2020, clearly.
Mm-hmm.
But there's going to be so many moves out there that are going to happen very, very quickly. And, if you're grabbing the 25% gains and then just, churning it and turning it into something else, buying something else, you're kind of losing out on that. You're losing out on the tax effect, obviously, but you're also losing out on that potential. That's something that could be turned into 100, 200, 300, 400% with size. That ultimately, I mean, let's be frank, it could be life-changing for you.
Mm-hmm. Mm-hmm.
So and then there's going to be times where the market's just in a flat-out downtrend, and you would say both position traders and swing traders probably should be in cash. I mean, that's going to be the case many times. You don't have to be 100% in cash all the time, but I think Bill was big on not being 100% out of the market, because he wanted to have a little bit of a thumbprint, a little bit of a sort of a link to the market, and actually be able to feel it in terms of monetary value. So I think that's important also for newer traders is, do your demos, do the simulations, do the trading simulations, but then over time, start to use real money. You have to dip your toe in at some point.
Yeah.
And whether that's, $2,500, $25,000, 50, whatever the number is, $800. Everybody starts somewhere. It doesn't matter, but just, real money on the line is going to give you more a real life feel to it than, using the dummy accounts. So.
Yeah, I definitely agree. I started out doing a demo, but I don't think I really felt like I was learning until I started with a small amount of money and actually felt what losing real money felt like. It just was this type of feedback that you don't really feel with just a demo account.
That's absolutely right. I've told all of Twitter this too, and I've blown up 3 times, and meaning that I've literally twice, I think it was a complete zero, count to zero, and then another time it was like half my account was gone. And this is all in the span of my early 20s, I'd say. And that is I don't want to say go out and do that, but learn. There's so many people that, even Bill talks about this in his book, his mistakes and how it led him to writing rules and all that. And so, but you can't really do that until you have some type of skin in the game. And that's what you really need to learn those lessons, to build those scars, to get that tough skin. Because that's what this market is about. It's about having tough skin. If you don't have tough skin and basically a steel stomach, you're not going to make money in this game, or at least you're not going to make a lot of money. Because in my opinion, I think it really does take, it takes a massive amount of conviction, a massive amount of patience, and it takes losing over and over and over again, and getting kicked and kicked and kicked to get these lessons of not just the actual rules of following, hold rules, sell rules, buy rules, but it's you're building that psychological stamina. You're building the ability in your own self, and that confidence in your own self to say, you know what, I can do this. I can make massive money at this. And I think that that's a critical component of a trader's development. It was a critical component of my development. And some of the best legends and traders in the world blew up a bunch of times.
Yeah,
it just happens. And so ego is another one. I mean, when your ego gets in the way, and I just remember first starting, I was like, oh, the stock Micheal Kors is never going to go down. And I tried some Micheal Kors, and I'm like, oh, I'm going to buy more on the way down, keep averaging down. And then what do you know? It's against me, and my ego got me caught on Micheal Kors. I don't think that was that wasn't a year that was a bad year for me, but that was a really bad trade for me, if I recall correctly. So, but you need those lessons. Like, the market is so humbling. It puts you into a state of mind that over time, and this is like years and years and years and years later, 5, 6, 7, 8, 9, 10 years later, it puts you in a state of mind that kind of says, you're not anybody special. You're a nobody. And if you just keep thinking that, and think that you're not smarter than the market, and just and learn constantly and never stop learning and be a student of the market, oh my gosh, you're going to make so much money. The newbies are going to make, there's so many people that made mistakes, and you read these books, you just you just don't do what they did. And you can save yourself a lot of money. That's the interesting thing too, is a lot of people, I mean, I've heard Jim Ropel say, all you got to do is copy Bill O'Neill and his template, right? Well, go to the back of the book and look at the top 25 biggest mistakes that traders make. Yep. That list at the very end. You go through that, and you look at a lot of your mistakes that can probably come from that book. And where did Bill get that? Well, Bill probably got that from either him doing it himself, or probably watching other brokers do it, or watching other fund managers do it. So over the years. So yeah, I mean, I think that's important in a trader's development. So yeah,
definitely agree. And in terms of stock selection, how important is fundamental versus technical analysis for you?
Man, that's a good question. So so there's an old saying that Bill is 70% fundamental, 30% technical. And for me personally, I'm probably more 50-50. If I'm being real with myself, I'm being probably more 50-50. I'm trying to get to a little bit, be more of a fundamentalist. You talk to any major hedge fund manager at Goldman Sachs or JP Morgan, it's interesting. I would say 9 out of 10 of them, they're fundamentalists. So they want to know what the grand theme is over the next, 3, 4, 5.
A dog just walked in.
I saw a little tail wiggle. Mine's behind me. He wants to know what's going on. So fundamentals are important. Technicals are important. I think both are. I've had some people tell me, hey, how can you be, 50-50? You're half good at fundamental and you're half good at technical. Well, that's probably not a bad thing. And it all depends on your style, of course, if you're more of an active person or versus more of a longer term person. But I don't want to know every single thing about a stock, like 100%, because if one little thing goes wrong, it could impact my psychology to just sell that stock if something happens. And then the other thing is on the technical side, if I have one little wiggle, if I know 100% about technicals and I'm just this, technical analysis czar, then I'm going to get scared out of position because the stock's going to go against me 10, 20%. And it's just actually doing a normal corrective basing period. Right. So, so that the fundamental versus technical, I want to be good at both. Do I want to be like this expert at both? Probably not. I want to be sort of, once I get into a stock, I kind of want to be, just kind of dumber, I guess, if you will. Watch for the fundamentals to change and watch for the story to change, of course, and then watch the reaction to that. If the reaction is negative, like very negative, and I'm talking slicing through the 10-week line on huge volume, 20% in 1 week off its highs, I mean, major sell signals, that's a different thing, right? That's like a Fastly, for example. It's a good example for that. That I would say I'm probably 50-50.
So I know that you post a list of true market leaders, potential true market leaders over on Twitter that is created by Ripley, your dog. So can you tell us about the stock selection process for that and how you choose that very select few stocks that make it on that list?
Yeah, so Ripley's very strict and disciplined when it comes to what stocks go on that list. That list is meant to be a list, sort of my go-to tier 1 level list. If you want to think of it like this, you can think of it like you have, in our military, you've got, special operations groups like special forces, guys like that. Now they're great. They're amazing at what they do, risk their lives, love them to death, love our veterans. But then you got the SEAL Team 6 and the Delta guys. Okay. And so those are the guys that obviously go through a lot more training. It's a lot more rigorous. And I would say that if I were to compare the true market leaders to that, I would say that they're like the SEAL Team 6 of the leaders. And so, and how do I define that? Well, I define that basically as they've got to have the best fundamentals and the best technicals, basically. So that list is constantly churning. There could be stuff. There could be stocks that come onto that list, and there could be stuff that comes off of it. And I watch that list very closely. I want to see if is it getting bigger in size, is it shrinking in size? Like I'll give you a great example is like Zoom came off of that list when they revised their estimates downward. I hear Ringo. And so that, Zoom came off along with a few other stocks that their estimates were revised, the 2021 estimates were revised downwards. So a lot of those stocks came off too, or stocks that went into a sort of a really severe correction or corrective basing period. Those stocks probably came off as well. So I'm looking at it from not only monitoring the market standpoint, but I'm also looking at it from potential buy candidate standpoint. Because if I'm going to buy a stock, I want to start with my tier 1s first. I break my stocks down into tier 1, 2, 3, and 4. So my tier 1s are going to be like your Teslas, let's just say Zoom back in June of 2020 when the estimates were beautiful. DocuSign, those types of fundamentals, those are the stocks that I'm looking at. for tier one. Tier two would be sort of like, they have a few kinks in the armor. Maybe they're not profitable. Maybe they are profitable, but maybe, last quarter sales were 10%, but the earnings were triple digit. So, and the technicals are still great. So those are my tier two stocks. So like I would say like a Stitch Fix would be like a tier two, 10% sales growth, triple digit quarterly growth, fantastic fundamentals. Earnings estimates are good, but I think I don't know if they're going to make money in 2021. If I recall correctly, I don't think they are, or maybe they are. But needless to say, that would be sort of like what I'm talking about. Now, your tier threes are probably going to be like your C limiteds, where they don't make any money at all. Fantastic technicals, but they got fantastic sales growth. Triple digit sales growth. Number of funds were in that spot of 0 to 500, 600 funds, 700 funds. It's got an amazing story behind it. That would be sort of like my tier three. And then my tier four would probably be something doesn't really have a really good fundamental profile, but just it's pure technical. Like a great example of that would be Overstock 2017. Excuse me. Overstock didn't have fundamentals at all, but it had a crazy story behind it, like with the blockchain, the businesses and the units that they acquired, the blockchain business assets that they acquired, really made that stock kind of just go. And that's another good example. Like that, I'd say like a Wayfair. Also, a Wayfair would be a good one. Just fundamentals not there. Tupperware is probably a tier four. These stocks that just have these massive, technical moves. That have obviously they fit the thesis and they fit the story, but they may not have the CANSLIM characteristics that we all look for. Like another good one, I would say that's up and coming. We'll talk a little bit more about this later, but Uber. Uber doesn't have the fundamentals that we all look for. It doesn't have the estimates. It doesn't really have the sales growth. In fact, the sales growth has kind of come off a little bit. On paper, if you were to say, Tesla or Uber, we're going to pick Tesla all day long on a fundamental basis, right? But why is Uber moving the way it's moving? Well, it's it kind of goes into, timing and being liquid enough, and the story is still young.
Yeah.
And so we'll get into that, but that's an idea of like Uber's probably like a tier four type of stock. All playable. So from tier one to tier four, these are all stocks that you can make massive amounts of money on. Outside of that realm, for me personally, doesn't mean that you can't make money elsewhere, but outside of that realm, not really looking at anything else. Like I'm not really interested in Bank of America or JP Morgan, where funds have just completely saturated it, and not really interested in making waiting 6 months to make 33% on my money. That's if you want to do that, like if folks out there want to do that, that's fine. I mean, whatever makes you money, and if you have that comfort of it, knowing that they hit all the but those are great stocks if you want to win a collegiate stock contest with respect to value. But for me, I'm not really those are not really in my realm. So.
Gotcha. And would you mind bringing up MarketSmith and going over to pins? Because I kind of want to ask you about earnings estimates for the next year and how important that is to you and your process. I think pins is a good example of very strong future expected growth.
Yeah, sure. Let me pull it up. Yeah, so this is a really good example of an earnings runway. I wrote an article for Trader Lion, and this is what I'm talking about. So you have stories that make a U-turn. Yeah. And Bill was big on plotting the trailing 12-month EPS line. You guys see me do it all the time on Twitter. I try to post. I mean, it's so cheesy. I get it. The graphics look awful. I can't overlay it because I don't have Panarray or Wanda, whatever they call it now. But needless to say, if there is so much truth behind that, if you're trying to sit for the big home run, this is what you're looking for. You're looking for something that does this. this unbelievable U-turn in annual earnings per share. This is what fuels stocks to go higher.
Yeah.
You have the general market, and then you have the earnings, and those are the two secret ingredients, along with, you could say, the Fed, interest rates. But I would say those are the big ingredients. What makes a winner is when you see something like this. So yeah, this is my full disclosure. This is my it's kind of bouncing back. Honestly, it's kind of bouncing back and forth between number one and number two with Tesla, because Tesla kind of pulled in, and then, added more to Pinterest. So it's kind of going back and forth. We'll just call it my number two largest position right now. And I think, technically wise, it looks a little soft up here. I think it's a little loose, probably needs to base for a little while. And I might get stopped out on my shares. I'm not really that concerned about it if I do. But if this thing rips higher, I want to be well positioned in it. I mean, ultimately, from its pivot, it's 100, says here 107% above its pivot in 75 weeks. Really, you could say, what is it from right here? So it's roughly around, let's call that 37 to, a little under 80. So, it makes sense that this is almost a measured move of, 90 something percent, maybe 95%. And it makes sense that there's going to be some resistance up here, some profit taking more than likely. So,
yeah.
But anyway, that's Pinterest.
Yeah. And I also want to ask you about fund ownership, both in terms of the number of funds and also the actual funds that are invested in a stock. So what kind of range for fund ownership do you look for? And also, how important is it the actual funds that own stocks you're looking at?
Yeah, that's a great question. So, if you look at March 2020 at 537 funds, I mean, that's phenomenal. You're looking for at least 5 to 10%. That's the minimum. I would say north of 15%, 20%, and that should be on your radar. Like, something's going on here. Quarter over quarter growth in terms of number of funds. Quality of sponsorship is really important. It's probably more important than the number of funds, but I don't know very many stocks that go from 500 funds to 1,000 that don't do this.
Yeah.
You know what I'm saying? So, one fund is important, yes, but there's a lot of smart money out there, and there was a lot of smart money that got into Tesla early on, and they made absolutely phenomenal returns last year. And we'll get into some of that as far as some of the funds that I've marked, but I think that keeping your fund list refreshed every single quarter is a big thing. You don't want to be messing around with a value fund. If you're a growth stock investor, you don't really want to be messing with a value fund. I mean, really all you care about is more of this right here, if that's what you're looking for. But if you're a growth stock investor, then you really want to stay focused on those growth mutual funds that not only did well, but really, really outperformed the market and really outperformed most of their peers. That's what you're looking for, is that super performance. You're also looking at NAV. You don't want to follow something that has a very low NAV. And the reason why is because who cares if, the mom and pop mutual fund of, $200 million did well? Are they going to be able to move the market if they're buying a 6% position in Tesla? Probably not. It's going to be, you're going to need NAVs north of probably $1 billion, I would say, if they're taking on 6 to 9 to 10% positions. And so some of these funds, a lot of these funds have mandates. They have to, they can't get above 10%. There's a lot of funds out there that they only have 36 stocks in their portfolio, in their whole mutual fund. It's remarkable. Think about that. I mean, we're talking billions and billions and billions of dollars.
Yep.
And, the interesting thing is I see a lot of people post their portfolios, and, I chuckle when I see, 55 stocks in this person's portfolio. And I'm like, there are mutual funds out there that have less stocks in your portfolio. Like, how do you manage that? That's insane. And that's why I post a lot about concentration. I want people to understand that you can concentrate safely. You can diversify through time, not through the number of stocks, but through time. You can hedge against risk through time, by slowly putting, your eggs in one basket, by slowly, contributing capital to one stock or two stocks or three stocks or four stocks that you think that have, massive potential. Quite frankly, I think if you have let's just say you have under $100,000 in trading capital, there should be probably anywhere from 3 to 4 stocks in your portfolio, in my opinion. If you're north of that, maybe 5 stocks. And the reason why is just simple math. If you have a stock that goes up 600% and you've got a 2%, 3, 4, 5% position in it, it's a nothing burger, man. I mean, it's not going to make you're not going to be rich off of that. You're going to have a nice, cute percentage to boast about, but it's not going to be something that's going to just change your life completely. And concentration is not easy. It's not for everybody. You're going to draw down. If you're holding right, there's going to be corrective periods. Not easy to do, but anyway, this is the recipe. I think you asked me a question about the number of funds. I would say 0 to 1,000 is sort of your sweet spot. It's a broad range, but probably I would say when you start to get into like 2,500 range on above that, the stock really isn't going to be able to do much.
Yeah.
Like Netflix. I mean, at some point, Netflix got saturated. Early on, Netflix had 1,000, 1,500 funds, to even 2,000 funds, and it still made good moves. So you can capture good moves with stocks that have, some fund ownership in it, but the odds are a little bit less. And it's a simple reason. The reason is because there's just so much more liquidity in the stock, and it takes a lot more buying to really pump the stock up. So here's the other thing, what I've noticed with liquidity really quick. When a stock gets too liquid, it doesn't take, in general, every new trader should know this, and the veterans know this. In general, with liquidity, it doesn't take a lot of shares to bring the price of a stock down. So in other words, it takes less liquidity to bring a stock down, like an Amazon or a Netflix or a Qualcomm or a Disney. It takes less liquidity to bring a stock down than it does to bring a stock up. It takes more liquidity to bring a stock up. Always. I've learned that over the years. It's a phenomenal that I don't know what it is. And I think it's part of it. It's, fear. Part of it is, constantly hitting that market order or, maybe it's just, they're just, the sellers are just, when the market rolls over, you've seen this before where you're like, golly, Amazon was down 10%.
Yeah.
Do you ever say to yourself, wow, Amazon was up 10% today? Does that ever happen? Or how many times have you seen Amazon's down 10%? We've seen it before. We've seen it a lot. And I think the reason is because it takes less liquidity, takes less shares to bring a stock down. That's why typically, that's what the old saying is, stocks take the elevator, the escalator up and the elevator down.
Yeah.
That's where that came from, in my opinion. So liquidity is very important. So my point is that if I'm going to be taking the same risk, kind of theoretically here, if I'm taking the same risk, why am I messing with Amazon or Netflix? Why wouldn't I go after something that has a lower float? Not necessarily low liquidity, low float and low liquidity get tossed in the same sentence a lot of times. And that's not necessarily the case, but I'm looking for stuff that's liquid, generally north of, I'd say, $100 million. $85 million is stuff that I like to play in. So I'm playing in liquid stuff. I'm not playing in stuff that's, penny stocks or, stocks that are under $15. I'm not typically messing with those stocks. But you look like a stock like GRWG, pull this up really quick, which in my opinion, this is a true market leader. Look at the float on it. Why do we think that this stock has done what it's done? The float is 29 million shares. I mean, you can turn the float on this thing very, very quickly. The number of funds that own it is 165. It's a very puppy, very much of a baby stock here, very baby company. So I'm just waiting for this thing to set up a base, and I'm going to, take a shot at it possibly. But this is a good example of something the float here reminds me of Livongo a lot, and we all know what Livongo did. But both stocks are liquid. I mean, if you multiply $48 times 4.226 million shares, what's the math of that? $180 million in daily average trading liquidity, roughly 175 million, something like that. So, so that's an example of a stock that is dynamic, has liquidity, and it's something that can double relatively quickly. You know, this stock could obviously go against you, but in my opinion, it's kind of the same. It's kind of the same risk. You know, you set your stop at a certain point. You know, you don't want it to be below a certain percent. So to me, it's like when you talk, you know, Paul Tudor Jones talks about 5 to 1. I heard Matt Caruso say that. That was drilled into my head when I first started in trading. Paul Tudor Jones is a beast. He's amazing. And that's what I'm looking for, is those unique situations where you have that risk to reward setup. I never like to assume that I'm making 5 to 1 on my money, because that's kind of like, you know, inverse of what I normally try to tell folks on, you know, predicting or projecting what your profit's going to be. Because I don't really want to trade like that in that mindset. I'm just going to let the market tell me when to get out of the stock. And I'm not the best person at selling into strength. I really am not. You have some rules around that, but most of my stuff is going to be selling on weakness.
Yep.
And because I'm willing to draw down to make sure that I didn't miss the move.
Yeah.
So anyway, but this is some examples here for you.
Yeah, it makes sense. And I want to ask you this. What are some catalysts that can kind of start a potential true market leaders run? And also, what are the type of kind of main buy points that you like to use during a potential true market leaders run?
Yeah, so there are 3 things, in my opinion, that define or make a true market leader a true market leader. And this is before the stock gets known. This is before the stock makes a big move. But if you can find stocks, this is what Bill said, this is the first one, that change the way you work, live, or play. That's a big one. The second thing, this is just kind of my research over the years. True market leaders, if you look at all the stories in the history of some of these stocks, what they've done, or these companies, what they've done, they've solved a huge, massive problem with an underserved, huge market or total addressable market. They've solved this huge problem. The third one is the company can touch billions of people. That's the other one. If you look at some of the biggest winners of history, you know, I think Beth Kindig said this in an interview. You look at Fang, like, why was Facebook so successful? Was it at first? No, it was too hyped up in the IPO. We all know that. But why was Facebook so successful? Why is Netflix so successful? Why was Amazon so great? Why was Google so great? They were able to touch billions of people. That's the crazy thing, right? And when you can snag on for a ride with one of those companies, you can make some serious money. And let me, I'm going to elaborate a little bit on point number 2 on solving huge problems with a huge market. Fang is sort of my touch the billions of people example, but let me, and then also change the way we work, live, and play. I'll kind of touch on a couple examples for everybody. So I remember when I did my studies of true market leaders, I wasn't just looking at the technicals. Everybody loves to look at the charts. I wanted to read the stories. The stories is what really gets me, because that's when you can kind of figure out, kind of going back to the fundamental thing, that's when you can kind of figure out before the story happens, what's going to happen. Now, that's not easy to do. That's incredibly hard to do. Most of the fundamentalists out there, they're going to just sit and draw down 50%, from their cost. And they're just be like, nope, the story's there. It's going to happen. And at some point the market's going to see it and I'm going to make all this money. And it's not a loss until I book the gain. Well, no, it is a loss. So risk management always first, of course. We didn't, as a CANSLIM investor, you do not let that, price of that stock go below 7%. I think 7% is too low, but you don't let it go below 7% below your cost ever. You cut your losses. That's rule number 1 is don't lose money. Warren Buffett said that, right? So, okay. Xerox, 1962. For some of the, older folks on this side of the computer, that was a big thing. that we didn't have photocopy machines back then, man. And that was a huge thing. Stock ran, 660%. It's 168 weeks. Huge problem it solved. Instead of having to write out and draw pictures and literally hand type or typewriter, a report. Literally, could you imagine, you're the assistant to the CEO of this big company, and he asked you to type up 10 reports of 50 pages, and you literally had to type up. That's how it was back then. All right, so Lorillard. I don't know if I'm saying that correctly, but this was a cigarette advertiser. Back in 1957, it ran 227% in 54 weeks. There's so many people out there now. I'm not going to push tobacco or anything like that, but there, after World War II, one of the craziest schemes, you could call it genius or not genius, it doesn't matter. We know that tobacco causes cancer nowadays, and I don't recommend smoking or anything like that, or buying cigarette companies. But the point is back then, and that's a lot of where Warren Buffett's wealth came from, was I think Marlboro, because back then they would send cigarettes with free. They would give them to our soldiers, and they would go overseas and they'd smoke.
Yep.
And it would reduce the stress. It was something that if they didn't have alcohol, they had cigarettes. And what happened? They develop an addiction, right? Because we know that tobacco is addictive. And so they come back, and what do? Guess what? They're Marlboro Reds or Marlboro's biggest customer now, or whatever the tobacco product is. So advertising wasn't really a big thing in the 40s and 50s, but it started to pick up steam. And there was a show, what's the show called? In the 60s on FX. It was a very popular show, and I think it was about an advertising company. God, what's it called? Do you know off the top of your head?
No, I don't. Maybe somebody watching can leave it down below in the comments.
Yeah,
we'll figure it out later. Yeah,
we'll figure it out later. But anyway, it started to become a big thing, and I think that this company sort of changed how advertising was done. The next one is Burroughs Adding Machines. Now these are all companies that most probably don't know about. They're not like the TASRs, and everybody talks about those. So I kind of wanted to find some examples for everybody to kind of see, take yourself back in the time for a second, and what was it like back then? Well, Burroughs Adding Machines basically built the first calculators, actual like electronic. I don't want to say electronic, but I think it was more of mechanical. But these machines were able to total and subtotal amounts when you typed it in. This was in 1926, and Burroughs Adding Machines, it ran 562% in 168 weeks. Changed the way we work, live, and play, right? So instead of having a hand type out and then doing it by hand, the arithmetic, you literally could punch it in this machine, and then boom, there you go. And look where we're at now. Now everybody doesn't even use calculators. They just get out their iPhone, right? And start doing it on the iPhone. And amazing how times have changed. But back then, that's the kind of stuff like that really. And then here's our darling, Bethlehem Steel. Runs 1,271% in 43 weeks in 1915. Now, most people think that Bethlehem Steel was just a steel company. It wasn't. It was also a ship manufacturer. And back in 1915, well, really, World War I started in 1914. And what did the U.S. military need? They needed ships, and Bethlehem Steel was the one that provided them that service. Not only the steel, but also they had the manpower and the schematics to build warships. And so it has this massive run in such a short time. So these are examples of it changed the way we work. These companies, they solved a huge problem, and they touched billions of people. These are some examples of those types of stocks. And that's what you're looking for. If you fast forward to today, why did Zoom do what it did? Zoom can touch billions of people. It connected literally billions of people and saved how many millions, if not billions of dollars of travel expense. And there's a lot of companies out there that have leaned out. When I say leaned out from an SGA perspective, selling general administrative costs, they've leaned out significantly because those travel costs have come down. Why? It's because of Zoom. It's because of the WebExes of the world. It's because of the, all these other products out there. But Zoom is the market leader. I mean, when Zoom decided years back to go from enterprise to, direct to customer and enterprise, that was like a huge thing for them. So they had all the infrastructure, they had the business model in place, they had the infrastructure in place, they had everything in place. And then COVID hits, and okay, Zoom got lucky, but at the end of the day, we saw it in the numbers and we saw it in the price action, right? So, and it solved a major, major issue. The whole story about the cigarettes given to the soldiers. Richard, think about that. So like, how many school districts, I think Zoom has done so much charity work and they've given so many free subscriptions to school districts. Are these school districts going to say, okay, when the vaccine comes, are they just going to be like, okay, all of a sudden, boom, we're going to quit Zoom? Probably not. I think it's going to be tough. It's to beat the sales numbers that were generated in the prior quarters. I think it's going to be tough to beat the earnings per share as well numbers, because those are phenomenal numbers. But having said that, there's going to be a lot of subscriptions that they're going to turn from free to charging over the next 12 months. And so that's the bet is that, okay, so it has the stock come off its highs enough to where the valuation is attractive to institutions, to where they view it as sort of cheaper. It's not a cheap stock from a price to sales. I don't really care about price to sales. We don't care about that. But you also have to kind of put yourself in the institution's shoes. I mean, the stock did run, what was it, 600-700% off the lows. It's had a massive run. There's a lot of stuff baked into it. You want some of that stuff to bake out. You want to get all that fluff out of it. And then where are we at? So that's the big question. And price will tell us, obviously, in the next few months. Mm-hmm. So, but anyway, no, I mean, it's Syntex was another one.
Yeah.
Number Syntex. So that was
birth control pill,
contraceptive. So that solved that solved a major problem.
Absolutely.
Back then, I mean, it was very frowned upon, and you had a more, probably a very, very more of a Christian mindset here in the United States. And it was very much frowned upon to take contraceptive pills. But needless to say, the 60s and the 70s, there was a progressive time and people were becoming more progressive. And it solved a major problem, pregnancies. And, maybe there was quite a few families out there that they knew that they couldn't afford, having a child. And so that was a better option for them, or whatever the reason was. But the point is that there was a market and there was a problem, and, Syntex solved a lot of issues and made a lot of money for Bill. I mean, that was what Bill's one of his biggest winners. And that was, I think, a lot of the money. I think a lot of the money that Bill got from that stock, he went on to buy printing presses and stuff for, daily graphs, and building his newspaper business was from the proceeds of that stock. And, that was a monster. That thing was a monster. So, triple digit EPS and sales growth. I mean, it had all the CANSLIM characteristics, high tide flag. I mean, it was a beautiful, beautiful run.
Absolutely. And I want to mention this because I think it's really important. And I think people should study this and really memorize all these rules, because you've compiled a list of relative strength characteristics to look for. And I don't know if you have it offhand, or I can just put it on the screen and post, but I think everybody should have a copy of this document that you've compiled of relative strength characteristics. And if you could maybe bring up that list and talk through why is relative strength so important for people to know about.
So relative strength, I tweeted this out quite a long time ago, and this is something for the little guy, just to have some type of edge up on the market. And the market will always tell you what to buy, not necessarily what to buy, but what to pay attention to when the markets are making new lows. And when the indices back in March, when the indices were making, there we go, cool. When the indices were making new lows, this is my guide. This is my template to figure out where where the relative strength really is. And, you know, I say right here, Nicolas Darvas eloquently stated in his book, How I Made $2 million in the Stock Market, I try to detect those stocks that resisted the market decline. I reasoned that if they could swim against the stream, that they were the ones that would advance most rapidly when the current changed. So think of it like a fish swimming upstream.
Yeah.
All the fish are downstream, but the winners know that we know that the winners are going to swim upstream, because once the stream current changes, those are the ones that are going to rocket higher. So just think of it like, you know, everybody has their analogy, right? So, you know, I think Mark Minervini has the beach ball underwater thing. I think Bill's talked about a coil, like a spring coil, like where you step on a spring coil in his book. You know, he says, you know, at some point when the tension's released, when that switch is released, you know, you're going to spring higher, right? It's the same. It's like almost like thinking of like physics, basically. And you're an engineer, so you probably know this very well. And, you know, there's a lot of actually strong corollary between physics, in my opinion, in the stock market. I'm not a physics person, but I would venture to say that, you know, speed and the rate of change, the rate of speed, you know, mass and force times velocity or whatever it is, you know, all that stuff kind of comes into play, in my opinion, with the stock market. You know, you've seen it a million times over, where when a stock gets kind of toppy or it needs a base, you know, the buying, the demand for the stock exhausts. And so supply takes over. And then conversely, when the selling exhausts and the selling is so great that there's just no more sellers, then the demand can take over, right?
Yeah.
So it's a seesaw thing. It's a seesaw thing. That's the mechanics of supply and demand. And this is just basically, for those that are new to this game, the relative strength line is something that Bill O'Neill puts on his MarketSmith charts. And it's a relative strength line of the SPX, or the S&P 500. I've kind of torn around with it in TC2000. I really think that RS line is really, Richard, of the SPY, not necessarily of the SPX, because if it was of the SPX, then how would that work? Because the SPX isn't updated, you know, real time in MarketSmith. So I think that it's really of the SPY, which is fine. It doesn't matter.
It's a representation.
Yeah. And so what I would say is that when you have a stock, one of the biggest bullish signs, in my opinion, when the market is making new lows and the stock can't make a new low, that is one of the biggest bullish signs that you can see or find on this list. And I can give you a great example. I can pull up a.
Yeah, go for it. I'll stop sharing.
Yeah, let me pull up market.
And for everybody watching, I'll have a link to that list, which everybody should have a copy. Download it, print it out, put it on a board somewhere. It's very, very helpful, especially during market corrections, in finding potentially the next true market leaders of the next cycle.
So right here, right? Okay, so this was Tesla made its low. Let me pull up the. This is probably the better way to do this on the daily, man. Look at that. Isn't that crazy? Now, everybody, you know, take that for what it's worth. We're on an arithmetic chart, so this is going to look crazy. But a log chart, unfortunately, MarketSmith doesn't have. That's another thing on their update that they got to do. They got to get a logarithmic chart for the daily. They can't, for whatever reason. It's on the weekly, but they don't have it on the daily. So this looks a little more intense than it probably really is, but nonetheless, it was pretty rough. So if we go here, the SPX, look where the SPX made its low. It made its low on 323. Tesla bottom on 318. That is like the most bullish sign ever. And then here's the other part of it is, then you take that and you add the fact that Tesla undercut barely the 200-day moving average. When the index and the SPX and the NASDAQ, not just the SPX, but the NASDAQ also undercut its 200-day by like 20%. I mean, it was something sick. Let's see here. Right here, NASDAQ. I mean, look how far below the 200. By the way, for the viewers, the black line is the 200-day moving average. So from right here, I mean, the NASDAQ was, what was it, 17%? That's at the close. Let's do it from right here. 18%. Let's call it at the lows, it was 20%. At the lows, it was probably 20% below the 200-day moving average.
Yeah.
Do you see the relative strength there? I mean, it's just like screaming at you right there. Now, I'm not saying, go and buy off the 200-day or, you can take a shot at it if you want, nibble, but we're talking take probing positions here. We're not saying, I'm not saying that you need to just throw your whole account in it, but that's something to be, something for noteworthiness, in my opinion. And then, everybody knows what Tesla did after that. And I can bring up so many examples. Like here's another great one is DocuSign. DocuSign didn't even go below the 200-day moving average. That is the biggest bullish sign ever, because at this point in time, this is where everybody needs to know the metrics. So when the market's falling, the sky is falling off. You got to pull up stockcharts.com or whatever it is. Is it stock charts? It's the one that has all the number of stocks below the 50-day, number of stocks below the 200-day, breadth, all that stuff. I think it's stock charts. Let me see. All right, so here's the NAA 200R. I mean, this thing got to like 7%. So this is the number of this. Oh, by the way, this is the number of stocks in the NASDAQ that are above the 200-day moving average. You go back to early March, 7% of stocks were above the 200-day moving average. Okay. How many stocks in the NASDAQ? Let's just call it what, 7,500, 7,700? All right. So what's 7% times 7,700? That's 530 stocks that were above the 200-day moving average at that point in time, roughly. I mean, that is like just so in your face, like, okay, now I really need to focus on the ones that have the best fundamentals, that are above the 200-day or near the 200-day. And that's where, if we go back to MarketSmith. Okay, so that's where, DocuSign comes through, and there it is. Like it miraculously held this spot so nicely. Now, granted, there was a crap ton of volatility that came into the stock. I mean, look how up and down this thing was. There was just a lot of volatility. I mean, the VIX was punching through 50, 60, 70. I mean, that's an incredible ATR, average true range, that's coming into the stock. So very, very hard to trade. And I'm not saying that, you have some type of, you're putting all your account around in here or anything like that. But the point is that you want to have a strategy that at least lets you participate in something like this. I've heard people call it relative strength. There's in the CANSLIM community, I've heard of some people during some of these seminars, they call it the relative strength buy rule. It doesn't matter where it's out of the chart. You just F and buy it on a follow through day. It doesn't matter if it's breaking out of a base or not. If it's showing relative strength and everything else is terrible and you got to buy something, then you buy it. Now, you need a spot, try to have 3 reasons why anytime you want to buy a stock, you want to have at least 3 reasons. That's a general rule. Tweeted something a little bit about that yesterday. That has saved my butt so many times over. When I'm just buying something to buy something, the relative strength rule of buying it and just buying it, you can find 3 reasons to buy it on a chart if you're just buying it for relative strength. That relative strength would be one reason. Maybe it, undercuts and rallies a certain moving average. Maybe it reclaims a certain support level. You can put some thought into it, to get yourself well. The reason why you want 3 reasons, because that's what you're looking for, is you want well-defined risk. Every trade obviously has to have risk. It's all about risk. And every single trade, I'm calculating how much I can lose when I exit that stock. And I do use hard stops. And I'm okay with using hard stops because I try to buy a little bit more uniquely. We'll get into that a little bit more, but I want to, sometimes I get stopped out. I posted some of my trades over the course of, the last 16 months or something like that, 14 months. And you would see me getting chopped up or stopped out a lot. But I'm risking very, very, very little amounts. I'd like to keep my risk extremely, extremely tight. And if I can't keep my risk tight, then I have to go smaller because mathematically it doesn't work. If I'm putting on a significant amount of size and I'm, you know, I'm setting 7-8% stops, that dog doesn't hunt. You know, that's not going to work over time. You're going to lose, and you're going to burn your account up. So the key for me is finding low risk spots that I know that there's, you know, very low odds of me getting stopped out, or of me finding somewhat of a intermediate or shorter term bottom. So anyway, needless to say, but this is a really good example of relative strength at work here. Dexcom was another one.
Yeah.
Zoom was another one. Teladoc was another one. Just the list goes on and on, like unbelievable. Now again, this sucked. I mean, this is a lot of volatility, right? So, and I didn't handle this well at all, by the way. And this was tough for me because I was probably entering it in this area, and I just wasn't, you know, the volatility was just too much. But certainly, you know, if you were able to stomach this, you made some really good money in 2020 off of Zoom. Anyway, so those are some examples of relative strength, and the list that you have there, you know, I've refined that over the years, and you know, that's my most up-to-date list, and I think that hopefully is going to help out a lot of people finding these true market leaders. Let me pull up one more example real quick. I want to.
Sure.
This particular stock is, I went over this on I did like a little, what do they call it? Restream or whatever on Twitter.
Yeah.
And this is one of those that I talked about. And the 3 waves down that you and I discussed, and that component, you know, the psychology of it, stocks tend to work in 3 waves. When there's a market, when you have a market that's correcting, you know, you typically have either it's in the market, it's going to do 3 waves, or the stock is going to do 3 waves down. And, you know, it's interesting. If you even go back to, it's almost the same identical base. You have wave 1 down here. And then you could say this is a wave, and then it did its final wave right here. And then it finally puked out that last holder of stock. It finally puked it out, and then boom, that was the lows. And it's funny how that works, because it's almost like the market's way of saying, no, F you, I'm going to put more pressure on you until you sell, type of situation. And so just think about how the market, it tends to want to work in 3s. If you look at some of the biggest tops, you know, I think it was Richard Wyckoff that had the various phases of accumulation and distribution.
Yeah.
And, you know, usually it looks something like this. Stock goes up, if you just follow my cursor, and then it kind of consolidates, and then it makes a climax top, and then it comes down, and then the stock kind of bounces up again, right? And then it finally falls, right? So it's funny because it's like wave 1, wave 2, wave 3, and then boom. Well, if it's almost the same thing in the inverse, with what Bill identified, it's almost the same thing in the inverse, because you fast forward to 2009, Apple does it again, wave 1, wave 2, wave 3, and then this little detail right here is important, because this goes back to the Tesla. Now, while Apple came off the 200-day substantially, it didn't make a new low when the market did. I'm sorry if you can't see that really well. Let me see if I can move this box. All right, so the market makes a new low on, let's just call it the week of 3/6/2009, and that was the actual low that got put in. Apple didn't make a new low, and you just look at the relative strength line. If we're talking relative strength here, if you follow this is at the lows, and look at look how high in the zone. So relative strength lines make bases too. Look how high in the zone the relative strength line is relative to the left side of the base of the relative strength line. You see how high that is? That is your clue, because what's going to happen is that even if this stock can't even get through the 200-day, even if it goes up, the relative strength line is going to push to new highs before it even breaks out of a base. That is like the biggest clue ever right there. those are kind of like little details you really kind of want to, you know, I hope, you know, I sometimes gloss over them and I go back and I look and I'm like, oh my God, that is like in my face. Like, this is unbelievable how, and then how many other examples are there out there of this? There's probably tons of examples out there. But this is what this is telling me is that the market was so awful.
Yeah.
That the relative strength line was almost at near highs on a stock that was below the 200-day moving average.
Yeah.
How bad the market was. But that is such a huge sign of institutional support. Anyway.
And after the market pressure eases, then Apple's off to the races.
Absolutely.
To all-time highs.
Absolutely. And let's just, you know, fast forward a little bit here and see what Apple did. It was a slower mover. Don't get me wrong. I mean, there was a lot of liquidity that already had come into the stock, and likely it was from this run right here.
Mm-hmm.
Because Apple's a very old company, and it was even an older company starting in June of 2003 when this thing started. But needless to say, from this base breakout, I mean, that's a two-bagger in a couple years. I mean, you got 100% of your money in 24 months. That's respectable for a stock this liquid. And I actually think this stock kept going. I think Apple kept going. Let's try 2013, see what happened. Okay, yeah. So it ran all the way up to, it based along the way, and it ran all the way up to, what was this? At the high, 695.
So 100 to 695, or if you bought off that first stage one base, like 150 or so.
It's 376 from the stage one base breakout of this flat base. You made 376% on your money if you stuck with it, and that's in a span of, call it 2 years, or call it 3.5 years, 3 years. That's pretty good. I mean, was it the fastest blow your socks off stock that you ever seen in your life? No, but I mean, we had stocks. We're so spoiled now. We had 2020. We had, like, I mean, if you didn't make 300% in terms of like this, if the stock didn't run 300%, you know,
it felt slow. Yeah.
Yeah, that's slow. So, and I hope folks understand that. Newer folks understand that. I've said this many times over, and you know this, Richard. The veterans know that this is not a normal market. 2020 is not a normal market. It's a market that will go down in history as one of the best bull markets of our time. You know, I really believe that, you know, your children one day, my children one day are going to talk about this. Our grandchildren are going to talk about 2020. That's how remarkable it was. And so the expectation needs to be, your bar needs to be set a lot lower, in my opinion, for 2020, 2022, and so on. And the reason why, and I'm not saying that I still believe in this bull market, and I think that the bull market has yet, you know, a lot longer to go, but
not at this pace, basically.
The pace, I mean, you don't see, I mean, there was, can I just pull something up really quick?
Yeah, go for it.
All right. So I got this from Kathy Donnelly, this idea of snapshotting stuff that moves. And Livongo was thank God I did this, because Livongo was one that obviously it got absorbed into Teladoc. But I mean, you just look at the sheer number of stocks that made massive moves in 2020. I mean, the list goes on and on. Net, Pin, Snap, Neo. Neo is a massive winner. DocuSign, I mean, CrowdStrike, ZS, Grog, APPS, FVRR, PDD, Twilio, Peloton, C Limited, Etsy, Fitch, Chewy, Emph, Sedge, Run, TTD, Roku. I got there was 28 stocks that moved greater than 300. I think my cutoff was 300%. It's 28 stocks that we could have messed with in 2020. You don't see that. And that's my point is that, you know, there may be 5 in a normal year. We had 28.
Mm-hmm.
So hope the viewers understand that it's not something that's okay. That's a CANSLIM grade, institutional quality. We're not talking about your little, firecracker, $20 million in liquidity, type of stocks. There's going to be those all day long. If you want to play those, you can play them, but not really my thing or your thing, I don't think. But this is a good point that 2021, 2022, it may not yield the same. And I don't think the odds favor that it won't yield the same amount of true market leaders or the same moves that we saw in 2020. So anyway.
Yeah, makes sense. And could you talk a little bit about how you judge market conditions in general, and also talk about how the Fed affects things? Because I think that's very, very important. And it's something I don't know too much about, but I think it's the reason for this super strong bull market as well. So I think it'd be worth going into.
Yeah, absolutely. So I put this out there on the interwebs the other day. I posted some stuff on on this S&P 500 and what the Fed did back in 2000, and because of the housing crisis, the Fed's like one of the most crazy, most powerful tools, and probably the single most underrated. How can I say this?
Forces in the market.
Well, they're underrated in the sense for the stock market that, or what's the word I'm looking for? Underestimated. That's the word I'm looking for. The Fed is probably one of the most underestimated tools for a stock market, like ever in history. And a lot of folks don't understand why, or in my opinion, they don't understand. Even fund managers don't get this. They should, but there's a lot out there that don't. This is unprecedented stimulus, quantitative easing, unprecedented interest rates that we had in 2020. We had unprecedented Fed movement in 2008, but it's of my opinion that literally we've done in probably less than a month, we did close to 2.5x in terms of dollars of stimulus for this economy that the Fed did first, from comparing 2020 to 2008. That is huge. And we did it in a month. And as you can see here, so just for the viewers, so quantitative easing is just basically the Fed is increasing their balance sheet by buying CMBS and MBS, mortgage-backed securities. If y'all need some more information on it, you can Google mortgage-backed securities. And, if for those that don't know what happened in 2008, let's just put it like this. It was a massive failure on both the consumer end and both on the banking end when it comes to mortgages, 1 to 4 family mortgages. But basically, in essence, the mortgage-backed security is what took down our system. It got fraudulent. It got overdone. There was too much premium on the bonds. There was an incredible amount of fraud within the bonds, meaning that, or toxic assets within the bonds. The underlying collateral of a mortgage-backed security is just basically a mortgage, essentially. And most of these mortgages were built up of, guys with, or gals with, families with, 500 FICO scores, 550 FICO scores, with very, very terrible DTI, or no income, no assets, no cash. They just had these big houses. So they were just, these massive rich house people with not a lot in their checking account, or that probably weren't worthy of a mortgage of that size. Then you have this product called the adjustable rate mortgage, which kind of kicked it into gear, because the adjustable rate everybody was getting teased with what these called teaser rates, and everybody were so like enamored with, oh my God, I got 1% of my mortgage. And it was almost like a thing. I remember it back in 2008. It was like, I got a 1% mortgage. Well, is it adjustable? Yeah, it's adjustable, blah, blah, blah. And it was like, you weren't cool unless you had an ARM, an adjustable rate mortgage. That's how it was. It's pathetic. And people were bragging. I remember people bragging about, oh, my mortgage lender gave me this mortgage and I didn't have to, show my W-2s. I didn't have to do this, that, or the other. There were millions of these out there, man. Millions of these. And that's what took down our system. So what does the Fed do? They buy these toxic assets from big banks to save the banks. Because if they knew that if the banks go down, that's up for a debate. You could say, well, the American people are going to pay for that one day, et cetera. That's all up for debate. We're not here to argue that. But what we're here to argue is, or what we're here to talk about is how the stock market reacted when the Fed started getting to work.
Yeah.
Right. And so what's interesting about this is that with QE, the Fed started buying these toxic assets and the market started to go up. QE was announced on November 25th, 2008. That was the first phase of QE. And it was expanded on March 16, 2009. I find it really interesting that was near the bottom of the market on March 16, 2009. Then the market rips higher and goes into another little mini bear market, I would say, kind of pushing towards June, really March, April 2010. We kind of fall. And look where the top was. March 31st, 2010, QE1 terminated. Pretty remarkable. This kind of goes on. They terminate it. They announce another phase. They terminate. They announce another phase. So it's kind of wobbly along the way, and you kind of see how the QE was just sort of spread out over time, right? The quantitative easing and the Fed's actions were really spread out over time. Then let's fast forward for purposes of brevity here. Let's fast forward to 2020, and what does the Fed do? All right, so there's a few things that happen in here, but boom, the market takes a hit. By the way, the Fed was already kind of taking a little bit of action in here. If you recall, we had an administration that was very critical of Jerome Powell and the level of interest rates in 2018. Remember, late December of 2018, there was a lot of talk about interest rates, and then the Fed starts lowering rates and sees a little bit of a recession on the horizon, so they change their tune or whatever. But then COVID happens, and that's what we're really interested in talking about here. Look how much stuff the Fed did in such a short period of time. I have the dates here, and I had to put this all in one block of comment box here because there was just so much stuff that they did. They cut rates to zero. They had $80 billion in government bonds announced that would purchase $700 billion in assets over the coming months with no limit. Encourage banks to use emergency funding sources known as the discount window. It's just basically a short-term borrowing window for banks, by the way. Loosen capital requirements and reduce reserve requirements for banks. So every bank has to keep a certain amount of cash relative to their total assets. Coordinated international action to lower pricing on U.S. dollar liquidity swap. I mean, boom, creation of commercial paper funding. This is like business loans. Creation of money market mutual fund liquidity facility. U.S. dollar liquidity. I mean, boom, boom, boom. And then here we go. March 23rd, 2020. This was days after they announced this stuff. They expanded more QE, quantitative easing, established 3 new emergency funding lending procedures or facilities. They expanded the CPFF, the PDCF, additional flexibility to capital requirements of banks, scaled back regulation on banks. Fed provides relief to small banks. New York Fed to buy $1 billion in Fannie Mae mortgage-backed securities. I mean, unbelievable, unprecedented moves in the Fed. And if everybody wants to know why the market's doing what it's doing, I'm not. I don't want to know why sometimes, but there are times when the Fed is involved, I want to know why. And I want to know what's going on as to why the market is doing what it's doing when the Fed is acting. Otherwise, I really don't want to know. I don't want to get too involved in the news, but the Fed is a little different. You want to know, there's an old saying on Wall Street, the smart money follows bonds and the smart money follows the Fed. And one of the biggest reasons, and you can kind of retweet this later, Richard, if you want, but one of the biggest reasons that got me onto the Fed was I remember watching an interview with David Tepper back in 2010, and I tweeted this, and it was with Joe Kernan on CNBC. I'm not big on watching CNBC or the news, but when that guy talks, I listen to that guy. He's a smart son of a gun, and he was buying at the March 2009 low, and he was buying financials, and he was buying stock. He was starting to, get into stocks. And a lot of it, and he said, just quite frankly, hey guys, well, the Fed is doing this. I mean, you follow the Fed. It's simple. It's not that hard. It's not rocket science. It's remarkable that, over time, you see these types of bull markets, and they're typically conducive to very dovish, a dovish Fed. Why is that? I think it's real simple. Just keep it simple. I keep it simple in my head, so I'm going to try to be simple here. Low interest rates means that it's easier to acquire. Debt's cheap.
Mm-hmm.
When you have low interest rates, debt is cheap. It's cheap for banks are not, they're charging, very low interest rates. Venture capital funds, hedge funds that do, credit strategies, they're charging very, very low in interest rates because there's a lot of competition right now, which is a good thing for the U.S. economy. But when the rates are very, very low, it creates almost like a demand for debt, and debt starts to pick up, and the Fed wants that because it's going to spur, loans to small businesses are critical in this country, and we need that. But when it comes to the stock market, it's easier to acquire a company if you get charged, 1%, 2%, 3%. Your returns are just so much better versus, if you're getting charged 10%. Well, guess who's keeping 10% on that, cut of the pie? Well, it's the bank that is. And so, you have that. So you have, stocks can trade sometimes on the prospects of being taken out. So low interest rates provide more fuel to that fire. Buybacks, that's another big one. When interest rates are low, stock buybacks, which can, bolster the stock price. The company itself. So if the company has, let's just say, for example, a lot of these growth companies, they have debt. Value companies have historically a lot more debt than growth. But there's a lot of growth companies that have debt out there on their books. And, when interest rates reprice downwards, whether they're tied to LIBOR, the London Interbank Offer Rate, or Wall Street Journal Prime, whatever that case is, when they reprice downwards, they're saving money because the interest expense on their books goes down, right?
Yeah.
So that's just more money to the bottom line, to EBITDA, to earnings per share, when you have such a low interest rate environment. It also creates an ability to borrow money on the company level, to invest to start new projects, to either buy new companies or to start new projects, or spend capital expenditures on maybe like a piece of machinery, a real estate facility, whatever it is, to basically increase their earnings, increase their sales, to increase their footprint. Maybe they want to expand into Europe or whatever it is, and debt's cheap right now, so they can do that. They can afford to do that. So that is in and of itself, the Fed is an incredibly powerful, underestimated, underrated tool for the stock market. And, hopefully I've laid my case out here for everybody, and I'm keeping it as simple as that. I don't really like to go too far else into it. A lot of people will overthink this, and, if the Fed does this or that or the other, and it's like they base their trading strategies 100% on the Fed, and, you don't want to be too close to it. But this is what I'm saying is my point is that that's what's giving me the conviction to sit. That's what's giving me the conviction to stick with this trend. Until the Fed starts to, get a more hawkish standpoint or hawkish stance, where they're looking to raise rates, they're looking to taper quantitative easing. Taper meaning they're going to slow the growth of the balance sheet itself. When they do that, that's when I'm going to start, okay, we might need to, start raising some cash, assuming I'm going to let my positions, not the market, not the Fed, but I'm going to let my positions take me out one by one when they decide to take me out. But not, I'm not going to just start selling as soon as the Fed changes their footing. I need to see my true market leaders and my positions become weak or trigger sell signals for me to sell. So anyway, that's the Fed.
Yeah, that I have never really been taught this, so this is super interesting, explaining it all and QE and everything. So thank you so much for that, man. Could you go into a little bit of an explanation of all the different oscillators that you use to judge the health of the market and the trend of the market?
Yeah, absolutely. So market in syncness is critical to my process. Market in syncness to me means being in sync with the market over a long-term, intermediate term, and a short term. I just got through explaining, obviously, my long-term thesis for a bull market. I want to stick with this trend. That's my long-term thesis. My intermediate term thesis is Bill O'Neill's rule on 13 weeks from a follow-through day. So after a follow-through day, we know that after 13 weeks, the move becomes obvious. It's not really, where's the demand at this point? You know, if it hasn't ripped within the 13 weeks, it's probably not gonna, it's probably a false breakout that's coming, or it's not gonna work. Yeah. Having said that, I will caveat that 2020 was an exceptional and an anomaly type of year. We all know that. And, you know, the market moved a lot longer than 13 weeks from the follow-through day. We saw that. Not something that's normal. Okay, having said all that, then I have short-term in syncness. So let's say, assume, for example, I'm within that 13 weeks of that follow-through day. Let's say we have normal market conditions. Something that I always told Eddie was that the market tends to want to move. When the market gets high up in its Bollinger Bands, when I say the market, I mean the COMQX and the QQQ or SPY or SPX, however you want to track it. Yeah. When it gets high up in those Bollinger Bands, expect a pullback, and then always have in the back of your head that the market's going to pull back, but the true market leaders are probably going to pull back 1.5x to 3.5x what the index does. We also know that. I mean, that's beta essentially. So having said that, doesn't it make more sense to wait for the pullback and then try to, you know, start initiating positions? Or would you rather initiate positions from an extended standpoint when the true market leaders are, you know, well above the 10 SMA, well above the 5 EMA, the COMQX is well above the 5 EMA? That is your cue to either, if you want to short-term swing trade this, get cash, not heavy, but have some cash ready to go for the pullback. Or if you're a position trader and you're trying to build your positions, I'm not interested in buying at that point. I want to buy when everything looks ugly, everybody's freaking out, the oscillators look very, very, you know, oversold. I don't like to use the word overbought, oversold when it comes to the, you know, stocks individually. But when you're talking about a composite of stocks, when we're talking about breadth, I use that I look at that very closely. And let me pull it up really quick so you can see what I'm talking about here. So this particular, for those that like the have TC2000, this is T2106, T2106. And so this is my MACD histogram. This is my MACD 1226. I got an exponential 9 on the bottom here. And then I have these lines here that I've built. These are proprietary lines to me. These, you can back test this and see how you want to formulate the lines. But green means buy, yellow means neutral, red means red, like stop. Like you need to like don't buy up in here. And so if basically this is a very short-term tool that I use to figure out the market in syncness. So I tweeted earlier about number one, is the general market right? Number two, is it the best stock of its class of 99% of all stocks? Is it the best stock of 100% of the stocks or 99% of stock? And then number three, what are the 3 points on the chart? We'll talk about the three. We kind of talked a little bit about the second one, but the first one, is the general market right? Yeah. So I don't mean the general market is right and you're buying up here or up here or up here or up here, because these are all high in the Bollinger Bands. If I were to put a Bollinger Band on this, these would be very, very high in those Bollinger Bands. Okay, so like if I go back to the indices, I'm going to pull this up really quick. You can see some of my moving averages here. But I mean, it's, my point is that I don't want to be, I wish I could have a, where's my, okay, here we go. I don't want to be messing here, messing around here, messing around there, messing around there. You see how all these points are near the upper part of that Bollinger Band? Yeah. Those are the spots where you don't really want to be messing with. Okay. Now, if you were to, overlay that with the VIX, you'll find that the VIX is actually making new lows around this area. And sometimes it's before the peak. but that's something else that you can kind of gauge the volatility, the VIX, the CBOE VIX. You can see that in around these areas that I have highlighted here, the VIX was probably starting to go green or heavy green, but maybe 3 days before this or 2 days before this, the VIX was making new lows. That's your cue to not buy. That you want to stay away from new buys because they're going to get crushed. All right, so then we add the flavor of the oscillator. So this is a 2 to 3 day thing. Maybe okay, call it I'd say 1 to 3 days. I think it's generally more accurate in the 1 to 2 range, meaning I can kind of time short term where a pullback is going to come. And I do that by waiting for this oscillator to get down into the 160s. When it gets down to 160s, I have the NASDAQ overlaid with this, so you can see how beautifully this thing works. All right, so if I look right here, I wish I could pull up my. All right, so if I look right here where the oscillator got down to right here, look what happened a few days later. So 2 days later, 3 days later, we got a follow through day. Actually, yeah, we got a follow through day 3 days later from right here. And this was a negative 140. That fails. You could call that a failure. It didn't really undercut the it didn't make new lows, but I think this was the, right before the election when the market sold off.
Yeah.
Funny how that works, by the way. I was in Colorado, like right here, trying to enjoy vacation, and I was trying to trade. It's funny how that works. I told Eddie this, man. Every time I like buy something, either extravagant or every time I go on a vacation, it's like the market's like, nope, you're too cocky. We need to,
bring that ego down.
Yeah, we need to burn that ego down a little bit. It's happens every time, bro. All right. Anyway, so look, it worked really well right here. You had a market bounce here, boom. But let's go back in time and look at the March 2020 bottom. Look where this sucker got down to like negative 248. Now it chopped around here for a little while, but eventually you knew that the bottom was coming. Now, basically what this gauges is on a short-term basis, the number of advancing versus the number of declining stocks. And it basically just, it compresses it into a very, very short time frame. It's not something that like, boom, it hits negative, 248 and then it's going to rally, 50, 60% thereafter. I have no idea. This thing is not for that. This is not for that. All this is to get a bounce. Like, you're going to get a bounce. You're at least somewhat certain, and you have more conviction on your bounces, and you can kind of time and game the market a little bit by using this tool. Let's go back to 2019. Take a look at this. Got down to negative 248. Boom, off to the races. You at least know you're going to get a bounce out of it. Let's go back to 2018. Boom, got down to what? Negative 2, call it negative 233. And then that was a pretty solid bounce that occurred back in early 2018. So you can kind of get an idea, like there are extremes on this that you can really use to your advantage. Now, once you're in trend, this thing's not going to go back to negative 250 once you're in trend. Okay, so this is an extreme thing. You're looking for the extreme points, but then you're looking for the normal bounce points. And so my normal bounce point is going to be the negative 165 area. The extreme is going to be the negative 250-ish area. So when I'm in trend and the market's moving nicely and the market decides to pull back within the 13 weeks of the follow-through day, I know that if it gets down in this area, there's going to be a bounce. I'm buying in here.
Yeah.
That's how I do it. That's how I get in sync with the market. That's why when I started following this principle, my win rate went up dramatically. I don't want to say it skyrocketed, but it went up dramatically from where it was. Having that discipline. There's going to be times where, you're buying up here and it works because you're just in such a strong market. You could have bought right here, man, and it's still, your stock could have still worked. So you don't have to, in crazy strong markets, you may get away with this, but I found that when I'm buying up in this area, even if it's in this area, if I'm buying above 100, the market's going to pull back and I'm going to get caught. So the more I follow this, that's what I mean by market in syncness. It's not buying strength. It's not buying when the markets are near all-time highs or making all-time highs. I do not want to buy stock, anything. If it's perfect, the risk is nothing, I won't touch it. Because when I do that and the market's going to go against me the next day. So stocks, just you think of it like this, it's like, they need time to cool off. And once they cool off, that's when you can start accumulating stock again. So that finding that rhythm is what really you're looking for. You want tailwinds. You want every single, you want to put every single odd in your favor. And you do that by finding these points, these little points in the market. It may not be 165. It could be down here. It could be in this area, whatever whatever you want to do. But my point is that you throw this in there with the true market leaders coming into the 10 SMA, 21 EMA, 50 SMA, 65 EMA. You throw that on there. On top of that, the index is pulling in to the 21 EMA or the 50 SMA or even the 200 SMA. You throw that on top of that, you got a VIX that's already kind of exhausted to the upside pretty substantially. You've got the makings of a beautiful bottom. Now, a major bottom, it's like we talked about earlier, the number of stocks below the 200-day moving average, put call ratio is absolutely through the roof. The oscillator is down here. The NASDAQ advanced decline line is, down in here somewhere or down in here, crazy, like roll off. Look at the histogram here, how oversold it got. You look at, this is something that your mentor, Dr. Wish, talks about.
The T2108, yeah.
The T2108, right. So when it gets above 80%, he talks about potential tops being there. And then below that, I think it's below 30% is the rule. You're looking for a bottom. Now look here. I mean, the number of stocks that were above the 40-day moving average. Don't ask me why T2000 does 40-day. I don't know who uses a 40-day, but
yeah,
whatever. All right. So although, 1% of stocks on 3/16/2020 were above the 40 SMA.
Yeah.
Ropel said in his interview with Arusha, hello, hello. Like that's, I was laughing hard when I heard that. Anyway, yeah, that's how I do it, man.
Yeah. And do you find that fear is a much better kind of indicator, meaning that when these indicators are on the oversold side, it's better than when they're on the high side? Do you find that fear is a stronger, factor than greed?
That's exactly right. These indicators, when it comes to breadth, fear is always a more reliable indicator than strength. And when it comes to secondary indicators, like the NAAIM that I track a lot, or track religiously, dude, that thing stayed at 100 for like 9-10 weeks in a row.
Yeah.
I've done so many studies on that thing, and I can tell you that there are very few times where it's stayed at 100, over 100 for that period of time. In fact, I don't know, I couldn't remember one time actually, other than the 2020 market, where that thing stayed as crazy bullish as it did. But I'll say this, the lows, it catches the lows pretty dang good. When that thing gets down to 0 to 10%, oh man, that low is coming, and expect it within 3 weeks. Expect it within 3 weeks. And
where can people find that?
Yeah, so if they go to www.naaim.org/programs/NAAIM-exposure-index. Let me share my screen with everybody.
And also, I'll put the link in the description so people can find it pretty easily as well.
Okay, so here's the NAAIM.
So what does this track, first of all?
So this is a survey that tracks the percent, really the average of fund managers that are either leveraged long or leveraged short. The range of responses is between 200 and 200. So if they're net short 200%, or if they're net long 200%, they're marking down on a survey and submitting it in. They do it once a week. So basically, this is kind of giving you an idea of their exposure levels. Now, I've never seen this thing go negative, meaning I've never seen it go leverage short. But when it gets to from 0 to 15, 0 to 10, you know, a bottom is coming. When this thing gets to like 85, there's a correction coming typically. But this thing is not as reliable to your point, it's not as reliable from a greed perspective, because fear is more powerful of emotion than greed. What is greedy can stay greedy for a very long time. What is fearful can only stay fearful for a certain amount of time. And the reason why is because at some point there are no more sellers. There physically is no more sellers. And if you were to go and look at a chart, a stock chart of the Dow Jones ever since the 1800s, and if you were to look at it on a decade basis or an annual basis, what's the regression analysis on that? You know, where's the line when you connect all the dots? Where's the line pointing? It's pointing up, right? Yeah. And why is that? It's because of America, baby. We innovate. You know, we find ways to make a living in this country like no other country, in my opinion. And I think that is a big thing for the stock market, is because there will always be new companies coming out that build a product or create a service that can reach and touch thousands of lives, can make maybe a single mother's life a little bit easier. Maybe a father is trying to provide for their family. Maybe it makes his life a little bit more easier. Maybe it's something that saves that family more money in the long run. Whatever it is, that's the beauty of the United States, is that we have a free enterprise system that creates these companies that when they do get listed, it's not shocking to me that our market over time has basically just gone up. Despite the setbacks, we have 2000, 2008, obviously, 2020, 1929, 1987, et cetera. But there will be setbacks and bear markets along the way. But those are the opportunities, and that's why you almost like over time, you do this enough years, you start to like realize, man, a bear market actually sounds really good right now. Some people would argue that they would rather have a bear market than a bull market. And they say that it's easier to trade a bear market than it is a bull market because of the RS line, because you can see them better. It's hard to see RS when everything is going up. You know what I mean? So anyway, back to this. This thing is more reliable in the 0 to 30 range. You're looking for 30 to 60 for a correction bottom, meaning that, the market's off its highs less than 20%, call it. Most true market leaders are off their highs less than 35%. So we're not bear market status. I would say that NAAIM will put a reliable bottom in at anywhere from 30. When the NAAIM number gets from 30 to 60, pretty reliable bottom for that the correction is done. When you're in a bear market situation, 0 to 10. That's kind of your bread and butter. 0 to 10, 0 to 15. That's your bread and butter. I've seen, I think it was 3% exposure was the number at the March 2009 bottom. 3%. Pretty remarkable. I mean, fear, right? Everybody was just sold out at that point.
Do you have any advice for people who want to do their own studies as it relates to something about the market, or just looking at stocks and moving averages and stuff like that?
What I would say is try to grab as much sample size. First thing, set a scope or an objective that you can, attain. Don't get too crazy with it, because then you're going to get halfway through the study and you're going to be like, oh, this is so boring. This sucks so bad. And I'm only like a quarter of the way done with it. So set realistic objectives. Okay. And if you have to break it up into multiple studies, do it in multiple studies. All right. That's the first thing. The second thing is, once you set those objectives, don't veer from those objectives. Don't start adding stuff like halfway through your experiment because you figured out something. Because when you start doing that, you'll never finish the study. So that's the other thing. So stick with the original objectives. But if it's something that's like really material and like you really need to know about it and you're willing to do it, just make sure you finish that study. Go back and redo it, but then just make sure you finish that study. Then I would say the third thing is make sure that what you're trying to get from that study is something that you really want to know, because if you're going to spend time on it, it needs to be something that's relevant to the market, whether it's, like you said, moving averages. It could be, stuff like this in NAAIM, studying secondary indicators, studying breadth, studying, I did a study on the follow-through day. Like on the follow-through day, there's an old saying in the CANSLIM community: the follow-through day needs to be on above average volume for it to work. Odds would favor that. Well, I did a study on it. No, that's not true. I went back and I looked at every single follow-through day from the 1800s, the early 1900s. Looked at every single one of them. It sucked. It took me like months to do, but it wasn't true. It wasn't true at all, actually. The market's going to do what it's going to do. There was very little corollary between successful, and I'm talking when I define a successful bull rally, I'm saying greater than 6 months. 6 months or greater. So there are very few bull markets that had above average follow through day volume. So that was one that I did. The pocket pivot study I did. Those anything that you want to try to build an edge around. That's basically your goal, is to you want to study it. If your thing is pullback buying, you want to be a great pullback buyer, do a study on what moving averages do stocks tend to want to migrate towards. I think that is a very underrated study. A lot of people, everybody's classically trained to buy breakouts. Everybody sees that. We see all the triangles and the symmetricals and the beautiful CANSLIM based breakouts, and those do work. That style does work. But in my opinion, in normal markets, not 2020 markets, but in normal markets, that stuff's going to get eaten alive. It's a liquidity event. And it's been classically trained into everybody's thought process and mindset within the CANSLIM community. So what you want to think from a psychological standpoint, what are most people doing? And then do the opposite. So if everybody is buying a breakout on week 17 from a follow-through day, what's the likelihood of that breakout working? Conversely, I will throw this at you. What's the likelihood of the breakout working of a traditional CANSLIM based breakout on the follow-through day, or before the follow-through day, or right after the follow-through day, like a day after, 2 days after? The odds are very high. And that's my experience. And the reason why is because nobody is buying breakouts. Everybody's bearish on a follow-through day, including myself. I am so guilty of this. And this is why it's on it's on my board. I have this on here. Never doubt a follow-through day. Exclamation point, exclamation point, exclamation point. I remember a story that Scott O'Neill told to everybody in an interview about the follow-through day. I think it was in 2010, 2009, something like that. And Bill had all the fund managers in there, and everybody was like, I'm so scared to buy I didn't buy any. Nobody bought on the follow-through day. Bill asked everybody. Bill bought stock on the follow-through day, and I don't think a lot of people did. And I think Bill called Scott in his office, like, why didn't you buy on the follow-through day? And it ended up being the bottom. And what's interesting is that here's the crazy part. If you go back and look at that bear market, dude, there was like 4 or 5 follow-through days. How many bounces, how many rallies, sharp rallies? That's the tricky part. That's the part that sucks. There's going to be times where that follow-through day is not going to work, and you're going to be in a position, and you're going to get knocked out of it, and you're going to be like, oh my God, this sucks. And then you're going to do it again, and then you're going to do it again. You're going to get knocked out again. Then you're going to do it again, get knocked out again. And then you're going to do it again. That's where, think about it from Scott's standpoint, right? So if I'm Scott O'Neill and I've got knocked out 4 or 5 times because I'm trying to follow this follow-through day process, and I'm doing it right, I'm following the rules. On that 5th time, what's my propensity to, want to buy stock on that 5th follow-through day? Not think about that. That's psychology though, right? So yeah, that's what everybody else is thinking. Everybody's thinking that. So think of it like that. The more severe the bear market and the quicker that the market comes off its highs, the more quickly you're going to get a snap back. You don't know. I didn't know that the market was going to do what it was going to do, but I did know that we were going to see a ferocious rally I'm talking 5-10% in a span of like a few days. And Jim Ropel actually called it in March. He said that there's going to be a snapback. You could make new lows. He caveated, but there was going to be a massive like rip your face off rally that's going to occur because the market was in such an oversold condition. And, you know, like we just talked about with the breadth and et cetera. So I don't know where I was going with that, but long story short is never doubt a follow through day. And if you get knocked out, you get knocked out. That's why you have well-defined risk. And that's it. Yeah.
Awesome. So thanks so much for going through the market conditions there and how you view everything in terms of the oscillators. And I think we're going to call it there and revisit all the other stuff that's part of your process in a future video. But yeah, this was great. I learned so much about really timing the market and QE and all that stuff. So thanks so much for sharing your process with us, man.
Hey, no problem. Looking forward to doing it again, Richard. And thanks for everything that you do and appreciate all the hard work you do. These are you do a lot of interviews and the FinTwit community is very thankful for that. And I just want to say thank you for everything that you do. So.
Of course. Thanks. All right. Thank you guys all for watching. If you did enjoy, remember to leave a like down below and subscribe if you're new to the channel. And we'll have Duckman on in a future video, talk about how he buys fear and earnings gap ups. But we'll leave that for another one. So thanks again for watching, and we'll see you guys in future videos.